Easter's nearly upon us. That doesn't mean we can all just lie on the sofa, eat chocolate and nod off. Anyway, I don't like chocolate and rather have a slice of Wensleydale. That aside, there will be plenty going on in the week ahead to keep us busy. Top down, what we've got coming up is UK inflation figures on Tuesday the 11th and UK unemployment numbers on Wednesday the 12th. Remember that UK inflation reached 2.3% in February year on year on the CPI and new CPIH benchmarks, finally exceeding the Bank of England's 2% target. Now, how much of that increase is due to a spike in oil prices, a jump in veg and salad prices after Europe's rotten winter and the pound's weakness remains to be seen. But the first two could easily be temporary factors, and that may explain why the Bank of England hardly seems to be rushing to raise interest rates. UK wage growth in January was 2.2%. Retailers and leisure players in particular will want to see that number exceed inflation, because otherwise consumers are worse off in real terms and they may start to spend less as a result. Unemployment, for the record last time, was around 4.7%, the lowest number since 2005. On the corporate front, several FTSE 250 firms will be reporting, so look out for interims from retailer JD Sports Fashion on Tuesday the 11th, trading statements from recruitment expert Page and bid target and engineering consultancy Atkins, as well as interims from WH Smiths on Wednesday the 12th, and trading statements from another recruiter, Hayes, and soaps to beauty and baby care group PZ Cussons, they're both on Thursday the 13th. But for me, the most likely source of a big fuss is the only FTSE 100 firm scheduled to say anything next week, namely supermarket giant Tesco's. It's due to publish full year figures on Wednesday the 12th of April. As we can see here, the shares are a touch lower than they were a year ago, which isn't that great given the FTSE 100 surged by 19% over the same period. The index has been helped by the perception that the weaker pound is good for exporters and enhances the value of overseas earnings. Tesco has probably been hurt by the weaker pound in the view that it increases import costs and boosts inflation, potentially crimping consumer spending power in the process and pressuring the grocer's profit margins. The spat with Unilever over Marmite prices is all part of the same big issue. In addition, some investors are clearly far from convinced by the planned £3.7 billion merger with wholesaler Booker. Big shareholders Schroders and Artisan are both publicly questioning the merits of the transaction. It's unlikely actually that this time around Tesco Chief Executive Dave Lewis is going to mention Booker much at all, not least as any deal will probably have to go in front of the Competition and Markets Authority. Anyway, that aside, at least ignoring Booker will give analysts and investors a good chance to look at how the core business is doing. And when it comes to the numbers, the following three headline items will be key. First, like-for-like sales growth in the fourth quarter. As we can see here, January's Q3 statement revealed an acceleration in the UK to 1.8% year on year, excluding VAT and fuel, as Tesco made its first market share gain since 2011. However, Europe and Asia both worsened. Second, headline pre-tax profit. The consensus is around 780 million against a stated figure of 162 a year ago and a pre-exceptionals figure of 435 million. This next graphic shows the 10-year trend in pre-exceptional pre-tax income plus the forecast for the next 2 years. Third and finally, the dividend. Disposals means net debts come down to around from 8.5 to 5.1 to 4.4 billion at the end of the first half. Whether that's enough for Tesco to resume dividend payments remains to be seen. Tesco cut the payment to nil for 2015 and passed again in the first half of 2016. This chart here shows the 10-year dividend history, and consensus is looking for a 0.1p final payout for last year, so there may be a token gesture, there may not. Watch out also for any guidance for the financial year that's just begun and progress towards the 3.5 to 4% operating margin targeted for 2019-20, underpinned by £1.5 billion in further cost reductions and average capital investment of £1.4 billion a year, although the Booker deal is likely to affect those over time, assuming it goes ahead, of course. Thank you for watching, and I look forward to seeing you next time.